In a dramatic twist that has everyone talking, President Trump has called on the nation's top money managers to lower borrowing costs. In his latest outburst, he urged the central bank to do the right thing and trim interest rates, a plea that came as their leader, Mr. Powell, announced plans to keep rates as they are for now. The president is convinced that easing these rates will smooth the rocky road ahead as his planned tariffs against Canada and Mexico approach. Could this be the spark for an economic turnaround? The stage is set for a bold new chapter. On April 2nd, a day Trump dubs Liberation Day, the United States will roll out retaliatory tariffs designed to counteract import taxes and trade barriers imposed by partner nations. In a post on his social media platform, he warned that the central bank's reluctance could hold the country back. Imagine a tug-of-war where every dollar counts. Lower rates not only lighten the load for businesses when they borrow but also free up cash for everyday people to spend on what they need. Trump firmly believes that this mix of rate cuts and tariffs will send the economy skyrocketing, painting a picture of a future filled with promise and growth. Mr. Powell, however, mentioned that while 2 rate cuts are in the pipeline for later this year, they won't come in time to support the president's Liberation Day. Even as Trump fires off criticisms, his administration's past actions reveal a relentless drive to reshape global trade. From imposing a steep 20% increase in duties on Chinese goods to slapping a 25% tariff on products from Canada and Mexico that stray from trade rules, his approach has been as forceful as it is controversial. And let's not forget the full restoration of 25% tariffs on steel and aluminum imports, a move that has left many wondering what comes next. The signals from Trump's tariff plans remain fuzzy, with many experts watching closely to see if any inflation triggered by these taxes will ripple through the economy. The president noted that the recent surge in inflation readings might be because people are rushing to buy before the tariffs hit. The central bank now faces a cacophony of signals as it tries to isolate these effects amid the din of policy shifts and delays. Even though the Fed has decided to keep its benchmark rate steady between 4.25 and 4.5%, there's talk of more cuts later in 2025. Yet, officials are quick to point out that inflation is still a stubborn foe, and they have trimmed growth forecasts, blaming, in part, the very tariffs Trump champions. When Mr. Powell insisted there's no rush to overhaul the current policy stance, it seemed like a calm amid the storm. Investors took heart, with major stock indexes, like the S&P 500, bouncing up by over 1%, a small but hopeful sign for shaken 401k portfolios. The ripple effects of the Fed's decision stretch far beyond Wall Street. Even though the official rate doesn't directly set the cost for car loans or mortgages, its influence is felt everywhere. Meanwhile, Fed officials have nudged up their inflation outlook for the year, now expecting price rises to hit 2.7% instead of the 2.5% they once forecasted, even though both figures are above their 2% goal. They also foresee economic growth slowing down further and the unemployment rate creeping up to 4.4% by year's end. This leaves the central bank in a bit of a pickle. Should it keep rates high to battle inflation, or lower them to give the economy a boost? This meeting marks the second time in a row that the Fed has held steady at around 4.3% as it watches carefully how Trump's sweeping changes in trade, immigration, fiscal rules, and regulations will reshape our economic future. Economists are warning that these tariffs may stir up inflation, at least for a little while. In fact, Powell pointed out that rising inflation expectations are largely driven by these trade measures. Just last week, tariff news even nudged the S&P 500 into what some call correction territory, where stocks dropped more than 10% from their peak. Powell summed it up by stressing that it's the overall effect of all these policy shifts that will chart the course for the economy. Could this cocktail of higher inflation and slower growth lead us into a dreaded phase of stagflation? Some experts are already hinting at a looming recession as consumers struggle with auto loans and long-term inflation fears hit heights not seen since the 1990s. With inflation expectations spiking in recent surveys, prompting both buyers and retailers to brace for higher prices, the coming months promise to be a true test of economic resilience. What surprises lie ahead as America faces this financial crossroads?